Welcome to the National Land Values Report. I'm Eric O'Keefe, editor of the Land Report, the magazine of the American landowner. Today's presentation marks the fourth year of this much discussed report. Joining me today are Steve Brewer, president of People's Company, which recently celebrated its 50th anniversary, Dr. Bruce Sherrick, the Bruin professor and director of the TIA Center for Farmland Research at the University of Illinois. Bruce is widely recognized as the nation's leading expert on U.S. farmland research and does much of the heavy lifting that powers this report. And Dr. Dave Muth, director of People's Company Capital Markets. Let's start with you, Steve. Give us a little background on the development of the National Land Values Report.
Thanks, Eric. Yeah, we started doing this report, as you mentioned, 4 years ago, and there's a lot of great research and great reports out there on farmland values. And what we recognized is that there wasn't a great all-inclusive report that covered all the major agricultural regions in the country. And as People's Companies expanded across the U.S. and opened up regional offices, we had clients looking for data on different markets and how different farmland markets performed relative to, say, the Midwest versus the Pacific Northwest or the Mississippi Delta, as a for instance. And a lot of the land value reports that come out, a lot of them are survey-oriented versus data-oriented, and Dr. Sherrick will get into this here during the report. But what we wanted to do is aggregate the data that is part of the NCREIF index, a lot of the USDA data that's out there. There's long histories, it's reliable data, and we wanted to pull all that together and aggregate that by region, and then combine that with our boots on the ground experience from our appraisers, our farm managers, our brokers, that are working in these regional markets, and put a report together that was, helpful for landowners as they make decisions on their farmland investments. So we're excited to present this report. It takes a lot of work every year to put this together, and hopefully everybody finds some value today.
Bruce, I'd like to jump a little farther on that point that Steve just mentioned, the difference between focusing on data versus focusing on surveys. I mean, that really is a distinguishing characteristic to the National Values Report.
Thanks, Eric. Yeah, we have at the University of Illinois developed a really impressive program from my perspective, the TIA Center for Farmland Research. It represents a collection of efforts across a lot of faculty and a lot of long-standing efforts to develop a consistent through time mechanism to keep track of what we describe as anything that affects farmland values. This, again, being the fourth time, we've kind of gotten it down pat on how to combine. I think we've gotten it figured out how to combine NCREIF data, which represent the largest institutional investors, and it's become really the true standard in understanding and indexing performance of investments by people who are, you could call it return-seeking capital investors, qualified funds generally. At the same time, we can look at all the way down to the farm level. In Illinois, for example, and across much of the Midwest, universities maintain very active farm level survey systems where we may have accounting responsibilities for actual farm level operations in the FBFM system, for example, or surveys by the various societies of farm managers and real appraisers. And we've developed a system to put that all into one consistent context, and at the same time be able to compare it to the performance of equities and REITs and alternative investments that might be on people's minds as we've gone through kind of a recent period of changing macro conditions. And we'll try to get into that in a way that kind of provides a context and a backdrop for understanding farmland investments.
Dave, when you deal with a wide variety of investors in your capacity at People's Company Capital Markets, how does this report bring greater insight and offer opportunity to them to better understand what's going on in these many different markets?
Yeah, absolutely. Thanks, Eric. It's interesting in the context of we'll work with a lot of investors that might be new to farmland, as an example, and being able to capture the diversity in farmland and how it returns and how it performs across different regions to help calibrate with them what their expectations of farmland performance might be and how to put a thesis together. And then some of the more experienced farmland investors that we work with, we can help calibrate the particular thesis that may be at hand that we're trying to execute and work through. So it becomes a backdrop. Certainly, like all real estate asset investing, you have to get down to the individual asset level to really understand and underwrite appropriately. But grabbing that context to be able to calibrate to what expectations, what needs are, it's really important. And that's certainly one of the real value adds of having this sort of aggregated reporting that Bruce is helping us put together.
Bruce, do you want to start off by giving us an overview of U.S. farmland markets?
Bruce, you're muted.
You'd think I would have figured this out by now after thousands of classes this way. So sorry about that, everyone. No, just said I want to start out with a high level set of indicators, and then make this into a conversation where we walk around the country metaphorically and talk about what's the same, what's different, how we might anticipate how we got to where we are, and what we think the future might hold. But again, starting off as a high level flyby. U.S. cropland values 2023, where we are now, and this is a survey-based set of information, so there'll be much lower numbers than you might think of for actively managed cropland. This is from USDA, so it's all cropland, hobby farms, people with backyards that have enough production to qualify as a farm, and across all asset classes. So when we get to the commercial scale or the actively managed assets, we'll have much higher numbers. But what's important about this set of data is that we can compare it through time and look at the rates of change in a very consistent way. And again, that kind of makes the level at which we're starting not as important as the rate of change. And in the last year, what we've seen is really quite remarkable still. The middle of the country, it's called the Northern Plains, from Kansas, Nebraska, South Dakota, North Dakota. That area has kind of caught up. The previous years in the Midwest and Lake States look that dark blue, and we've had that 3-year period, as Steve mentioned, of absolutely remarkable appreciation. But that's a 1-year pattern of change in values. If we were to look at a kind of 3-year total pattern, you'll see something fairly similar, but just absolutely astounding numbers in terms of percentage price change. When we get to the points of talking about returns rather than price change, we'll add in the income, we'll subtract out property taxes, and we'll convert it to a number that's more like what an investor or an owner would actually have experienced in terms of a rate of return. And again, I think people are often surprised that the last 3 years line up this way. It's been, again, nothing short of remarkable to be able to say that the annual rates of return have been double digit in many, many cases. And again, focusing on where we are now puts the upper Midwest and the row cropland into kind of stark relief relative to the rest of the map. But over the long period of time that you'll see when we get to the individual regions and talk more about the drivers, it kind of evens out. And to be honest, most all farmland investments look remarkable when you look at the long term.
Did you anticipate this coming out of the zero interest rates and where farmland markets had been just a few years ago, or is this a welcome surprise?
I would say that's a great question, and I would say I'm not surprised by levels at all. I'm surprised by the degree to which farmland remains a very accurate inflation kind of covariate. It has moved very well with inflation, and we kind of have a rolling narrative around this, and quite often people will remark, it's shocking that farmland almost anticipated inflation, or It's shocking how well that's done through time. And I don't think I'm surprised by that. I'm surprised by the accuracy or the degree or the strength of that relationship, if anything. And again, over the 30-year period, just to point to the slide that's in front of us, you see that things do kind of even out, and this is a total return. So it takes into account property taxes, expenses that one would have to have in a managed situation and so forth to get what I think the best analog to, if you were looking at your 401k and you said, gosh, it's up 11.5% every year for 30 years. That's because Berkshire Hathaway is kind of in the news.
Yeah. I've made some great choices there, right? I mean, if it's up 11.5%, correct?
Yeah, it's like the coin flipper who calls heads and gets ahead and thinks, "Gosh, I'm a great coin flipper." If you were in this asset class, you did very, very well. So, Steve, I don't know if you have other comments, or Dave, on just the pattern of returns you've seen here.
Yeah, I think it's hard to ignore the history of what farmland has done, and one of the conversations that we run into on a routine basis is when you look at it on the surface when you're making that acquisition. A lot of times the cap rates in Midwest farmland are 2 to 3%, and for people that are buying their first farm, they look at that and they struggle with those returns. And I've joked around through the years that we offer a money back guarantee on farms that we sell, because once you've gotten into owning farmland, you realize that the entry cap rate and return is much different than what you experience once you get into the asset class. And there's just so many different levers to pull and so many different opportunities in farmland that drive these returns. And I think that's what Dave will get into in his remarks later. But farmland has historically performed incredibly well, and it's done exactly what it was made to do during this last 2 or 3 years of an inflationary environment, which has provided great appreciation along with nice cash yield, and that's why people call it gold with a dividend.
Yeah. The black gold reference to Midwest farmland and Pacific Northwest farmland, and of course the powerhouse that is California. We'll kind of walk through those conversations regionally as well. Just to put the point I was trying to make there includes the fact that crop production is not uniformly distributed around the country, and livestock is not uniformly distributed around the country. So the areas that we'll walk through, we've divided up into what I think are really reasonable regions based on the same way NCREIF keeps track of their regions. So we'll talk about the Pacific Northwest. We'll talk about California. We'll talk about the Southern Plains with Texas and Oklahoma. And we'll talk about the Northern Plains and the Lake States and the cropland in the Midwest and so on, because they have very distinct production characteristics. We don't grow oranges in North Dakota. We don't grow a lot of sugar beets in, the middle of Colorado. There's just places where you can grow things. And we don't have cattle in certain places of the country and so on. So when we walk around, it's kind of important to keep this one in mind. It's both proportional to land mass. So Texas and California, of course, pop out. But it's also important to look at the middle of the country. Iowa, Illinois, Kansas, and Nebraska, and recently Minnesota and the Dakotas kind of increasing their relative share just because of the catch up in production values there. So want to kind of double back on one issue that's been recurring and really critical to have a kind of a visceral understanding of, and Steve, you've mentioned it a couple of times already, farmland as an inflation hedge. And I think this is a remarkable chart. If we were to put together the top 32 states in terms of value of agricultural production and create an index as though you had, essentially bought an acre in each of those states. It's not quite weighted that way, but we'll go with that. And then just look at the total return you would have gotten and the inflation rate that was underlying the asset at that point in time. You get this remarkable pattern that the only time farmland has not outperformed CPI is essentially in 2009 as a sympathetic response to the housing crisis. We had overnight rates that absolutely shut down. We had kind of a complete implosion in asset markets, didn't know how to trade. We had people pulling back, And within a year, though, the flight to quality arguments and the return to value had reversed itself. And then the other period of real importance is the last few years, since the beginning of the pandemic, the flooding of the market with cash, the attendant interest and inflation rate environments that have occurred since then. It is a bill like farmland had been the only asset that anticipated that correctly. And we'll talk in more detail about why we would expect farmland to behave as an inflation hedge and why the idea of inflation itself should land on fixed assets in something like this pattern. But I just wanted to kind of show people that. And what's important is we've updated now that we've gotten through the third quarter. A lot of things that end in 2023, by the way, it's important to note that they will have modifications or slight revisions next year when we get final numbers. But by now we're going to be pretty accurate, honestly, on the year-to-year inflation numbers, the year-to-year CPI numbers, the year-to-year farmland returns number. We got that down pat. And this is kind of the pattern you'll see, even if they both move up or both move down a little bit for the final dot. So here I kind of wanted to convert from me doing this much of the talking to kind of the conversation as we walk around the country. And Eric, what I'll do is kind of tee up each region, and then we'll kind of talk about what we think the big issues are. There's some consistent information provided for each region. There is some unique information provided for each region, and then there's a story to tell for each region. To kind of put a very busy slide, and these slides will be available afterward, or you can zoom in as needed. I won't talk through the numbers, but we like to think of the country as being somewhat divisible into the following regions, and these are the same as we use for NCREIF. So there's a consistency in location when I'm talking about USDA aggregations, and there's a consistency when we're looking at NCREIF data. And again, NCREIF data have only commercially managed, at scale, intentional farmland investments included. USDA data have the entire universe, the entire population of farmland owners included. And the top section by location, the bottom section by NCREIF designation. And in the report, the written version that we'll provide as well, there's a much more extensive table of NCREIF returns by location, crop type, management type, and so on through time. But I think what's important, if you look at the last couple of columns to start, and look at the bottom, the NCREIF lifetime performance for total, annual, and permanent crops, all north of double digits. The 20-year most recent period, even better than the 30-plus year period of time we had at 1245 total farmland, permanent cropland, which over the long run, we would expect to have higher returns than annual cropland, just the additional risk of having assets above ground. Even though if you go to the left side of the screen now, the 1-year performance on permanent cropland has suffered. And we're going to talk about that when we get to the first region. And again, guys, this is where we all will have different ideas and opinions about it. But California land values are driven both by agricultural values, converted use value, pressures from populations, increasing values of underlying products that are produced. And the NCREIF data happen to have a very heavy concentration in tree nut investments. And Steve, I know you know a lot about kind of almonds and pistachios and the water situation. And I think you're the person who described it to me as kind of a sorting out market at this point in time. What are you seeing in California?
Yeah, we've had a period of low nut prices that, the folks that are in that industry have been living through over the last 3 or 4 years. And it really started out largely with a lot of plantings going in when capital was cheap and there was a lot of acreage expansion. And the Trump tariffs hit, and then that, killed demand internationally for the nut market. And so you had both expanding acreage, and then you had, the supply side get hit. And so farmers in California have been struggling for, several years now, working through the glut of inventory, and pricing just hasn't been ideal because of that. And now you're entering this period where operating capital, call it, prime plus one, you're paying 9% for your operating capital. And so the folks that are farming in California are getting hit pretty hard right now. And as a result of that, you're starting to see some pressure on prices. And we'll talk about Sigma as well, but there's the political environment and the water challenges that are also impactful in California. And so I think the thing that I would say about California is that if you're committed to being in that market, then folks are hunkering down right now, and they're working through some of these challenges. But it's definitely sorting out the folks that maybe got into California because it was fashionable or money was cheap. And now the true players are going to be the ones that emerge and own these assets and are going to grind through these challenging times. And there's acreage being removed right now, which is going to help with that glut in the market. But the market, as you say here, sorting out is definitely where things stand right now. And transactionally, 2023, there wasn't a lot of transactions in that California market as it's sorting out, but there's starting to be a lot of properties hit the market, and really anticipate 2024 transactionally being pretty vibrant.
Steve, let me throw in a quick question about a phrase you used, being committed to being in the California market. Obviously, there are producers that's their basis, that's their focus. But how about from a national standpoint, establishing a diversified portfolio? What are the advantages of having a position in California?
It's actually one of my favorite markets in that there's just so much optionality. I always say that if Iowa's not number one at it, then California is, and if California isn't, then Washington is. And when you look at the crops and the agricultural production in California, you can really grow anything that you want in California. And then you've got the unique Mediterranean climate where there's only certain things that can be grown in California and they can't be grown anywhere else. And so when you think about what's happening with the water markets, the amount of irrigated plantable acreage is shrinking. It's got a unique climate where you can only grow certain products in California. And so, think about Central Park and New York. You've just got a limited amount of acreage, and the acreage that's left standing as this all sorts itself out, I think is going to be more valuable over time. That water resource and that unique climate is actually going to make that land more valuable because of the optionality of what you can grow on it. And so, folks that are taking a broader perspective and looking at different regions to invest in, this is going to behave different than the Midwest, but it's part of that diversification play on crops and water. So I'm bullish on, the California land market because of what's happening, but it's all about having good water.
Always the key.
I think the comment to add to that, California, if we had divided it up into states the size of Rhode Island, would be a bunch of states that are also unique in their production capacity. As you said, there's only a few places in the world, not just in California, but in the world that you can grow pistachios. Only a few places that have the designation Napa or Sonoma when you're talking about wine grapes. Only a few places that you can grow 3 sets of vegetable crops per year reliably, because the sun always shines and the temperature is always, very fixed and influenced. And so California as its own region makes sense because it's so many sub-regions. When we get to the next parts of the country, you'll see we go from 1 to 2 to 3 to 5 to more and more states that have consistent production regions. So that optionality effect and that sorting out, and as Sigma becomes fully implemented, it's a Sustainable Groundwater Management Act. And as California figures out its water infrastructure, we had a giant recharge event, biggest snowpack and melt in a long period of time. And yet you can't say it was, necessarily captured to its full potential. It kind of, a lot of it disappeared, and makes the kind of susceptibility to a future drought higher than it might need to have been. Varietal modifications, as we, no longer want to have navel oranges in our fridge, but easy peels in our kids' lunch boxes. Things like that in California have been why it will always be a major powerhouse in production of fruits, nuts, vegetables, wine grapes, dairy, other things. It's not just the size of the market, it's the uniqueness of all the submarkets. Just again, pointing out at the bottom, still remarkable long-term rates of return. Again, these numbers that you see at the bottom, when you see them in this format, are a bit attenuated or a bit conservative, I guess I should say, relative to what you would get from like a NCREIF response in the long term. NCREIF has lower numbers in this region because of a couple of very large properties invested in very specific crops that, again, over a long year, 20-year, 30-year, lifetime investment case, I would argue are like the 20 and 30-year lifetime numbers we saw in the previous chart. So moving on, Pacific Northwest become one of my favorite places and one of the places that I think has the greatest potential going forward. Partly because of Steve's comment about optionality. You can grow potatoes followed by barley, followed by bluegrass seed, followed by, maybe garlic, followed by organic hay, followed by the next thing. It's, again, a sequence of places where there's a lot of wheat grown under irrigation, in particular, highest yielding wheat in the country. But the things you can grow there and the substitution for other parts of the country that might have long-term production problems is highest there. I'll point out that, again, the returns have been nothing short of remarkable. And that the current transactional volumes from my conversations with folks in the region, the larger players, including folks in Steve's shop, have said transactional volumes are really, really off, but that might be just building a pipeline. People are trying to figure out what's coming down the pipeline. Steve, there's been like crop to crop some massive realignment as well, and figuring out where that's going to go. I'm not sure how to put the crystal ball in front of us, but I agree with you that it's the most flexible region, good water resources. But I've also observed that it's kind of like the end of the slinky. When you pull the front of the slinky, which is the Midwest crop market, it takes a while for Pacific Northwest to kind of feel those same set of pressures. And so I'll just point out, anticipating what everyone is going to see, that the slopes of the lines here are not quite as dramatic. They're not quite as variable. They're just kind of this slow and steady and kind of happen after the rest of the country comes out.
Hey, allow me to interrupt just for a second, please, Bruce. I just want to emphasize the cost to enter this Pacific Northwest market and put in a plug for the Land Investment Expo, which is going to be returning to Des Moines on January 9th. I interviewed Drew Bledsoe in Walla Walla, Washington, and went to his Doubleback winery and spent a day listening to his story, transitioning from NFL quarterback to winemaker. And one of his key points to me, obviously Walla Walla is his hometown, and he went to Washington State just a few hours away. But one of his key points about making great wines was that his land costs, as you pointed out, when you have those Fifth Avenue addresses in Napa and in Sonoma, his land costs in Walla Walla versus Napa and Sonoma are 10% of what he'd have to pay there to produce a comparable, really appealing wine, which I thought was just money well spent, money well invested.
Yeah, Eric, to double down on that, Dave, you should talk about what we're doing with what we're seeing on the carrot side and the returns we're seeing in some of that migration again from California into the Pacific Northwest.
Yeah, we've been watching this, sort of anticipating with Sigma that we mentioned when we were talking about California, Pacific West, rolling through the various different sort of compliance processes and through that regulatory regime, and ultimately impacting acres that can be farmed, that get water. And you kind of look at some of that fresh market production. Tomatoes is an example that comes to mind. Steve mentioned carrots, right? The Pacific Northwest is really well suited for being able to produce at very high levels, very high yields, these crops. And if you look at the Columbia River as a resource, it's less than 5% of the water in the Columbia River that's used for agricultural irrigation. It's really an amazing resource, an amazingly consistent resource, and very affordable, right? So you've got a lot of hydroelectric power generation, very low cost electricity for pumping the water, that as a surface water source, the energy use is low. these things all combined, it creates an environment where you've got some of the highest yields on the planet in some of the major crops. Think about potatoes. 90,000 pounds an acre of potatoes out of the Columbia Basin is a pretty standard target. Even you go to a crop like regular field corn, right? Our old adage is if you didn't get 200 bushel in Iowa or Illinois, something went wrong. In the basin, we're talking about if you didn't get 300 bushel, something went wrong, right? So these are really incredible factors that are driving. And I don't know that we have hard examples that have built out robustly yet, but we definitely, being in this marketplace, are seeing at least that phase of exploration on some of those fresh market crops that may have some compressed acreage to deal with and higher water costs to deal with in California, looking at the Pacific Northwest, the Columbia River Basin area in particular, as a transition point.
This strikes me almost from a stock picking standpoint as the difference between large cap and small cap. The opportunity for upside in a market like the Pacific Northwest, which more and more investors are looking at and scrutinizing, but doesn't have the cachet, as Steve mentioned. I mean, there are how many different crops that you could only produce in California, whereas Oregon, Washington, Idaho, that region are producing robust yields of a lot of what I'd consider really strong marketable products that are generating exceptional returns.
Yeah, another note on the Pacific Northwest market that's sort of interesting is there is a lot of these fresh market production industries. That's both row crop and permanent crop. And there's a lot of, multi-generational family style, vertically integrated operations that have been a part of building out the ag industry up there. And we are seeing some interesting dynamics with some generational transitions. And that ties to sort of additional vertical integration and maybe some institutionalization. Certainly the institutional capital is a big fan, generally speaking, of this region for all the reasons we've highlighted. And those are some things that we see kind of coming down the road just a little bit in the Pacific Northwest.
I think the attractive thing to me includes the fact that in the Midwest, you can, I can pretty much predict. There were a couple of auctions yesterday, and we ran a little like side bet at one of the conferences we were at where the auctions would end up. And, we all picked numbers without even thinking that we're, within $300 to $500 of each other in terms of our expected price breaker. And it was largely because we can look at the bushels of corn production capacity, and whether you're in north central Iowa or central east Illinois, 250 bushel an acre corn ground is 250 bushel an acre corn ground. There's some local basis to deal with and so on. Well, in the Pacific Northwest, 300 bushels compared to 250 bushel in the Midwest, those relationships move through time differently than they do in the Midwest alone. The output markets, whether you're sending them to chicken feed or export and so on, are really a little bit distinct. And so I do love the description, the flexibility, access to market, the ability to respond to changes in that part of the country, and very high and very supportive of asset values. We'll move on, and we won't spend as much time in all the regions as we did on California and Pacific Northwest, partly because it's an area that this is probably the area I know least about out the regions, but Southern Plains we're going to look at as Texas and Oklahoma. Sometimes other people put other regions in it, but from a perspective of having data that we trust and represent the region well, we shortened the time period to 2000 and to present. It's a little harder to go further back. The reliance on cattle in the region and ranching and use of grain for feedstocks for animals as opposed to selling at whatever the number 2 yellow corn price might be, make it a little harder for us to look at croplands separately from agricultural investments generally in the Southern Plains. And we've all heard about the Ogallala Aquifer and the, western Oklahoma and northern Texas and on up through parts of the northern plains. And water will always be critical, and water might become increasingly critical. And it's an issue that we will have to continue to deal with, but it's always been dealt with. Likewise, labor is a complicated thing to deal with, and it might be getting more complicated, but it's always being dealt with. The thing I want to point out is that when we get closer to the end of this webinar, we'll talk a little bit more about the energy market and traditionally oil and gas and managing energy alongside of the other agricultural resources has been key to this region's profitability through time, key to the economic development, key to the value of the state in general. And again, this increased attention to greening of the energy complex. I think we pretty much all agree we're going to have more wind, we're going to have more solar, we might have hydrolytic installations, we might have additional ways of capturing carbon either from an ethanol plant or by crops putting to the ground that will all change how we do the calculations around what a calorie generated by photosynthesis is worth, whether we put it into our stomachs, into an animal's stomach first and have meat, or whether we put it into the gas tank of our SUV. It's all part of that complex that's evolving rapidly in the Southern Plains. Eric, you live there. You probably have to read more headlines around this than all of us. And tell me if I'm off, but I think the degree or the volume around this conversation has nothing but increased.
Oh, it's exponentially, Bruce. Particularly what we're seeing is optionality. Think about it 20, 30, 40 years ago when someone was looking at buying a ranch. Out in the area that you just mentioned, for instance, out in the Great Plains, the northern reaches of the Panhandle or the South Plains around Lubbock. If there were transmission lines across that ranch, that might X that one off the list and that property may not be considered. Now it's seen as a huge asset. That means there's the possibility of transmission lines. That means there's the possibility of a electrical substation. When it comes to wind, when it comes to solar, when it comes to carbon capture, when it comes to all of these additional revenue streams that are creating a lot of value for investors, Texans are jumping on it. As you may remember, Governor George Bush passed the legislation or initiated the legislation that passed and made Texas the largest wind-powered state in the nation, eclipsing California. And that drive towards additional energy, whether it be obviously nations leading in terms of oil and gas, but also now looking at renewables, now looking at other forms, including direct carbon capture. I think that's going to be a complete game changer, and I think it's going to be driving land values in Texas for decades to come in ways that literally we can't anticipate. I remember an interview I had with Aubrey McClendon at Chesapeake, and he was talking about the development of fracking and how you look at the Permian Basin, and once upon a time, we all thought that the Permian Basin had been played out. It's now producing more oil and gas than it did a century ago, right? And he felt at the time that people are going to look back at where we are now and see this as the beginning of a new bonanza. And I feel that really applies to large swaths of agricultural properties that have and offer additional optionality.
Yeah, you guys are making the point that I was going to talk about later. But when you talk about land values, and a lot of times, a lot of what we're talking about is interest rates and corn and soybean yields, and how that gets capitalized into land values. And I think this is the wild card. I think right now we're in debates with clients. I'd rather buy a T-bill than a farm. And one of the things that we talk about, well, you can't 1031 exchange into a T-bill. You can't add leverage to a T-bill. You're never going to have a data center pop up along a transmission line or a solar project or a wind project or a carbon storage pipeline next to your T-bill. So I think that's a huge question for what we're working on here today as far as evaluating agricultural land values, or how do you price that optionality into the farmland market? And we all experience it, we all know it's there, but it's a hard thing to get your hands around.
Steve, you recently expanded and developed a new energy management division at People's Company, precisely with this in mind, correct?
Yeah, that's right. You know, historically, when you thought about managing oil and gas interests, there's a lot of trusts, foundations, nonprofits that have, through the years, accumulated interests in oil and gas. And, you know, in our farm management business, our mailbox gets filled up daily with letters from renewable energy developers looking to do battery storage or solar projects or wind projects on farms that we manage. And so what we've done is we've bucketed up our oil and gas business with our renewables business, and we've created our energy management business focused on advising landowners around these renewable projects. And, you know, Texas and Oklahoma are fun because you've got the old oil and gas business and you've got the new renewable business combined. And it's a pretty exciting time to be in both spaces right now. And I think the conclusion is we need both solutions long term, and I think that's becoming more commonly accepted. And so we've tried to put our clients in the middle of that conversation.
And that's exactly what Boone Pickens told you and told me in his all of the above strategy, which is wind, solar, oil, and gas. They're all American resources, and they can all give us energy security. That is a unique opportunity for our country to be able to not rely on foreign sources for its energy. And that drives more and more value back to land and these agricultural investments, does it not?
That's a fact, and Boone was ahead of his time, as you know, Eric. And in addition to his view on energy, you may hit on the water rights play that he had as well around his ranch. But he was ahead of his time for sure in his views on water and energy.
No, he was just one of the, and pardon this aside here, but I met Steve through Boone Pickens, who came to the Land Investment Expo to be a keynote speaker in 2014. And I had spent a lot of time at Boone's Mesa Vista Ranch, and Steve eventually came to the ranch and got to see this amazing Xanadu in Roberts County, Texas. And one of the things that struck me about Boone's ability to perceive value was the fact that when he started buying that ranch land in the 1970s, it was priced at 175 to 200 an acre because it was just considered cattle ground. And he recognized the value that was inherent to that property. He literally sold the water rights for hundreds of thousands of acres that he bundled under Mesa Water, hundreds of thousands of acres for $400 an acre, twice the purchase price at its lowest. And that's not even counting the additional revenues that he developed from other revenue sources. So again, that goes back to your point, Steve, about optionality and the ways that we're entering a new frontier when it comes to the values of land.
Eric, I actually have triggered a question just around recreational properties and lifestyle properties, and that market went nuts during COVID. And what are you hearing and seeing from the folks that you work with at the Land Report on these trophy properties? And is there pressure with the economy slowing down and higher interest rates on these trophy properties that don't have income associated with them? I know, you know, the Mesa Vista Ranch just traded hands recently, and how are those folks looking at those opportunities?
At the highest end of the market, there is no letdown in the demand for these properties because, as you have seen in many instances, these are all cash transactions. So interest rate pressure does not matter here. And there are so many individuals who are looking for that premium hunting tract, that fly fishing on the Madison or on the Gallatin, and they're willing to jump at whatever comes to market. I think that's has been and will continue to be a major driver. the right address, the right piece of property, and not so over improved. That was Boone readily admitted. His great his Achilles heel with the Mesa Vista is that he over improved it with all those fantastic lodges and houses and meeting facilities, and his lake house, his 13,000 square foot lake house. That made it a lot more difficult to market. But at the current market today, the higher up you go price point wise, the more easily a property will sell.
Makes sense. I appreciate that.
So, Eric, just to keep moving through the country too, and we love to sit around and talk about these things for 4-hour blocks, and we could, in fact. And there's a lot to learn from kind of that change in availability of things that cause value. And this year, we're adding in Northern Plains, Southern Plains as special focus points in the report, just because of the major changes in the things that are driving value. And I just want to switch up to the Northern Plains. Again, Northern Plains, goes a long way down through the country. It's just divided up by that, and the name may not be quite as apt as one would expect. And the Northern Plains is so long and so distinctly different climate. The water situation in the north is there tends to be too much water, and in the south there's never too much water. Sorry about that. And we want to look at this and think about the performance. And there's been a bit of a catch up in returns. The early part of the run-up didn't happen quite as quickly in Nebraska through North Dakota and Kansas and South Dakota, but it did happen. And if you look at the end of this chart, the increase in values have been rather dramatic compared to other parts of the country in the last 3-year period. Part of that's driven by relative yield gains. You can grow corn in the northern part of this region with productivity that you couldn't, not just because of the increasing number of frost-free days that are apparent, but it's also the genetics and the attention to doing genetics for this part of the country by the major seed corn and other seed producers has made this a possible competitor for the rest of the country. Huge numbers of cattle and poultry produced in the region, huge use of food in the region, use of feed in the region of the grains grown. And if you look at the chart at the bottom, amazing performance. Truly amazing financial performance. And again, the South Dakota situation is one I'm probably most familiar with because I also study crop insurance, and the southeast corner of South Dakota had a major crop insurance event in 2019 with major floods. The southern part of this region is more concerned with irrigation and how to manage the cost and perhaps increasing cost and perhaps increasing regulation around water issues in the southern region of this the Northern Plains market. Guys, anything to add on that one, or should we move?
Really quickly, Bruce, I always like to look at this region going back to one of the initial maps you showed on total returns over the long period. And you see this region along with a little bit in the lake states kind of jump out as having slightly higher total returns over a very long period of time. And I think your comments around corn technology from a genetic standpoint and a management standpoint, being impactful and expanding value and yields into the Northern Plains, that's really a big piece of that. I mean, it's been significantly impactful, and that's worth noting on how that kind of jumps out when you look at a map.
One other comment I want to jump in on, guys. We've had several significant sales in Kansas in 2023, and Bruce, on one of your prior maps, I think Kansas actually showed one of the higher 1-year return metrics in the country. And what's interesting about that market is, you've got a lower basis for land, and they've got some water challenges in parts of Kansas where you've got ground that ultimately you're running out of water, but you can currently grow 250 bushel irrigated corn. And so when you get these years of $6 corn, the local farm community can get pretty aggressive at buying cheaper land that ultimately is going to depreciate over time as the water resource runs out. But in the short term, they can make a lot of money on an annual basis on 250 bushel corn at $6 on lower value land. And that pops that land market up and in the short term. And my experience and handling quite a few transactions in that market is that market can pop up and then it can pop back down pretty darn quick too. And we started to see that real time this summer in the Kansas market.
If we wanted to make an even more controversial version of that, it's not just the basis. If you buy something for $1 and it goes up by $1, you made 100%. If you bought something at $10 and it went up $1, you made 10%. And that basic starting level in the price of land is exactly what you described. There are a lot of other issues around foreign ownership, anti-corporate farming, and other things that are beginning to enter the narrative. If you pick up a farm publication, you're going to hear about things like that. And the anti-corporate farming laws, we have to figure out where they're different and how they work and what the impact are. But if there isn't an institutional buyer to kind of catch the market on the way down, you can sometimes end up with unintended consequences of restricting who can buy and sell land in a region. And in addition to the area directly to the right of the shaded part of the screen for the northern part of that's the part of the country that's most restrictive at minimum in terms of who can own land.
Yeah, to add on that, North Dakota is where you saw that the headlines this summer of the Chinese buyer in North Dakota, and that's what triggered a lot of the conversation around foreign ownership. So North Dakota is restrictive, South Dakota is restrictive. Nebraska on corporate farming laws, they found those unconstitutional. So you see a lot of institutional interest in Nebraska. Kansas, there's very little to no institutional investment in Kansas because of the corporate farming laws. And so we had a sale in Kansas almost next to the Colorado border, and a competing firm had a sale in Colorado where you can have corporate farming players. And you see a difference in these types of markets where the farmers aren't driving values. If you take that institutional investor out of the market, it definitely impacts land values, and we saw that real time this summer in Kansas and Colorado.
I'm going to hop down to the Delta market next. This one's a fascinating region, and it ties into some comments we just made. This is kind of the area where the institutional players focus, partly because there's very large tracts compared to farm at a time or 80 at a time or 160 at a time in the Midwest. But also because the entry cost and the ability to make improvements, change, convert production systems, it's a little bit more untamed, I guess, would be a descriptor in terms of the agricultural region. A little harder maybe to manage the tenant relationships and so on, but really pretty good returns and pretty manageable returns through time. This is a market, again, where Mississippi, Louisiana, and Arkansas are what we would use as the proxy for a slightly larger region up and down the Mississippi, and distance from the Mississippi has an awful lot to do with the farmability and the access to water and the ability to transport grain after it's grown up and down the river if needed. A lot of exports from rice in particular. Cotton in this region is a critical crop. We have had kind of a move into and out of synthetics around cotton that have changed the value. But crop insurance is also really critical for farming, and rice, cotton, and other crops that have really strong support from crop insurance markets, I think, are going to be safe for a really long time. It's also a really boring set of pictures to look at, included both the cash rent and the price on this one, because it's just, it's as steady Eddie as it can be. When we get to the absolute end of the conversation, one of the comments that might be worth remembering is if you put any other asset on these charts over whichever period of time we show, if it was the S&P, if it were even Berkshire Hathaway, if it were an oil stock, or if it were a shoe manufacturer, you're not going to have this long, slow, steady appreciation that generates this high of a set of returns. You might have a higher total return, but you might have a year where you lose 30% or 40% or gain 50% or, have tax implications for the swings in income that are different than you have in this. And so I think the stability, the ability to know that you're going to have some inflation protection, and the alpha relative to other investments in this region drives things. And Steve, I know you manage an awful lot in this region, and Dave, you've put together some unique and complex projects. What else is going on here?
Go ahead, Steve.
Yeah, I was just going to say you've largely got this is a major market that's driven largely by institutional capital, and so there's a lot of institutional interest here, and you've got some of the crop diversity that we've talked about in some of the other regions with rice and cotton and corn and soybeans and wheat, and it's just a great market. I think you've summarized it well. Just steady as she goes, and you don't get necessarily the same swings that we get in the Midwest in this market, and I'm really bullish. You've got plenty of water. You've got large fields, and one of the issues we do struggle with in this market is the tenant pool. You don't have that same competitive nature for tenants that you've got in the Midwest, and so sometimes you've got to get more creative with some of your direct operations in terms of squeezing the return out that you want because you don't have that competitive nature in this market.
Yeah, one of the interesting dynamics that we see down here, and talking about the Southern Plains and this sort of expanding income from non-ag based sources and energy in the context there, like recreation actually matters a fair bit in the Delta. When we're underwriting assets down here lately, it's really quite often where that recreational income that stacks on top of that core ag income is actually impactful, right? It actually kind of impacts your core thesis on an individual asset. And so that's one note that's really emerged, and it fits into this broader notion of farmland creating more income kind of sources.
I have to remark that one of the first meetings I was at with an institutional investor, there was a 5-minute debate on the productivity and a 20-minute conversation about the duck hunting blinds and what condition they were in when they were looking at a property. So I think that is key. Moving to lake states, Dave, you pointed out that this was a region that kind of pops out as well. I want to echo that fact too, the kind of catch-up effect in the 14.2 for the last 3 years total return. Those are real numbers. Minnesota, the lower part of that is really just northern Iowa and vice versa, corn and soybean region. As you get to Wisconsin, you have a little more diversified agriculture reliance on dairy that's moved out in many ways to bigger dairies in the southeast and southwest, but still really critical for production. Some other unique crops, cranberries and so on. And then Michigan, which to some degree is the Pacific Northwest of the Midwest, where we have wine grapes and cherries and apples and blueberries and production of vegetables, and kind of the thumb area is really critical for that, and stone fruit and the other southern and western. There's just an amazing diversity of production in this region, and that gives some optionality. But again, Steve, I heard you describe this as still trying to figure out who they're going to be. Great optionality, reasonable acquisition prices, and massive increases in land values that have kind of kept the returns high, very correlated with inflation as well.
Yeah, there's definitely some sorting out of that market. We're involved in some blueberry transactions right now, and the blueberry industry struggled in the Michigan market. And so as those acres come out of blueberries, or tart cherries is another example, where the tart cherry industry's shifted to a lot of foreign imports. And so as those acres convert out of blueberries and tart cherries, what do they go into? And we were up there this summer at Michigan State University with their extension folks. And I think it's a big question for the state. And I know Michigan State and other researchers are really trying to figure out where is our acreage going to go long term. And, I'm seeing a resurgence in apples in this market, and that's largely to do with, one, it's a great place to grow apples, and but that competes with the Pacific Northwest, which is perhaps the greatest place on earth to grow apples. But you've got the whole shipping cost game, and so I think you're going to see that market continue to evolve and sort itself out as it transitions from some of the historical crops that it's grown and looks for alternative uses for some of these acres as they convert.
The Southeast market, again, a slightly shorter period of time that we like to use to describe it. And two reasons. One, the data are a little harder to get reliably. Two, I think the region has reinvented itself, and the current is more likely to describe the future than the past in this case. We've seen a complete citrus transition in Florida because of HLB or greening, and the fresh market production in the country shift to other regions. We've seen, Ian, most recent, or some recent extreme weather events, including things like Ian. I shouldn't have classified it as just that, and some other big surges have made crop production sometimes subject to more risk, just as an all-in risk, and especially for permanent crops. Some large properties, some small properties, but there's not like it is in the Midwest where you could say, gosh, if this operator didn't want to do it, there's 24 more waiting to take over this, radish production facility. So I think that's all true. But the big story is that there are more of us, and we're living there when we get older, and we're competing with southern destinations for attractive tax reasons and attractive climate regions and attractive other things. And so growing houses as a transitional crop turns out to be one of the ways acreages are changing in that region. Still a huge number of poultry operations in the Southeast, a huge number of cattle, and be an area where the energy transition may not happen in the same way as it does through the heart of the Corn Belt. But this is just a tough area for me to totally figure out. And if I were picking a region that I'd have the least confidence in forecasting forward on the agricultural side, it might actually be this one. But supporting that on the other side are all those transitional issues. I'm actually not worried about land values hardly at all in this region for traditional agricultural things that get displaced for a retirement community or a park or a golf course or a Major League Baseball facility. These aren't reductions in value. They're just a reduction in the use of it for agriculture.
To hammer home that point that you're making there, Bruce, state of Texas loses a section, 640 acres every day to development. And that can obviously be freeways, that can obviously be shopping centers, that can obviously be subdivisions. But when it comes to higher and best use of a lot of particularly grazing ground, not necessarily row crop farms, but grazing ground, pastures, you're seeing a lot of that transition throughout the South, Texas, throughout the South, throughout the Southeast. And I'd bring up that key indice, the U-Haul index, which shows for the last 4 to 5 years, I haven't seen the most recent figures, but the most number of one-way drop-offs of U-Haul trailers have been to Texas, Tennessee, and Florida, which goes exactly to your point as far as land from a transitional standpoint going out of use, whether it be pastoral, whether it be agricultural, into growing houses and multifamily.
Yeah, no, I mean, one of the greatest tourist attractions ever is zero personal income tax rates. So people have moved to states where that's been a feature. So
definitely.
The area that we'll kind of end with in terms of the extensive conversation about factors would be the Corn Belt. And we know most about this, I think, because it's the most densely transacted where we live and have most of the information. Plus, we have just tremendous data. We have good state level data, good USDA data, good NACREAF data, and so on. But this is where corn and soybeans are grown, where hog production has moved around a little bit, but still fairly critical. And access to a river, whether it's the Ohio or the Mississippi, was traditionally good, where we added ethanol plants and completely changed the demand for corn, perhaps forever on, where we have kind of a lowered density population demand, or like overlapping demand from population pressures is not so great here. And so it's really truly agricultural numbers that you're seeing. And just focusing on those long-term, even the worst period of time, 2014 to 2023, where we had kind of a tapering off of prices. The 2012 drought drove corn and soybean prices up. The period after that was kind of a lull, and we had, Iowa tends to go up faster than Illinois, and Iowa tends to come down faster than Illinois on prices, but Illinois and Indiana are the two absolute bellwether kinds of indicators for what's happening in agriculture. Indiana has had a remarkable run up and kind of a catch up. Ohio may not think about it as the corn belt, but truly still is. And then Missouri, we include in this region. It could be in other regions too, but because there is still a heavy ability to grow things and send the feed through cattle instead of to ethanol markets. In this one, I like to put the CPI or the inflation number and the CMT10 or the Treasury yield alongside a few key markets, just to remind us of the gap, the degree to which, if you're looking for inflation adjusted returns, whether or not they move up and down in the same way. And except for the 80s, I put a very long-term chart on this one. So you can see in the 80s, the only other time when there was any meaningful reduction in values, and those were low rates of return. And in the 2014 to 23, even though there was some retrenchment in prices, the total returns were actually still pretty good because we had income numbers, especially 12 and 13, and then uses for the crop through time, way better crop insurance markets, very low borrowing costs. The total economic situation at the end of the period still was very supportive of agriculture. And most importantly here, again, you see the inflation hedging positive alpha effect that comes out of this market. Dave, Steve, what?
Yeah. Well, Bruce, I'd just like you to go a little deeper, and I know this isn't a completely fair question, but earlier this year when CPI was running 7-8%, I was really bullish on the land market because of your slide at the beginning of the presentation, which shows farmland and inflation positively correlated through time. And on one hand, you're cheering on, like, the more inflation, the better my farmland's going to do. But then as CPI cooled down now and you've got this higher interest rate environment, that was really the question for me is which one trumps which one, and when this levels out. But the question is if I told you what CPI was going to be, what inflation is going to be, what would you tell me the return above CPI will be for farmland over time?
Yeah, so the gap that we see, I have a chart in the longer report that tabulates that by decade. And again, I think we're going to run long on this webinar, but we have a 44-page report that gives a lot more detail on this and answers a lot of those questions. And we can look at it, in the 80s and 90s when inflation was not really the key policy target, we had a gap of 5 to 6%. And then we had a long period of time where inflation was much lower and was a policy target to manage by the Fed, and we had a gap, 4 or 5%. And then we get back to this spending kind of environment we had both in 2009 and recently. The term I have used is we've had sort of untethered spending on everything, and so the pure monetary version of inflation has been pretty easy to predict, frankly. And we still get a 5-6% total gain over inflation through the long term. I think that number will compress. We've got reasons that we've, in a sense, de-risked agricultural investments. So we would expect the gap between what you would think of as debt yields and equity yields to be compressed a bit. And that's happening in agriculture. That's okay. The lower the cap rate, the higher the multiple on income, of course. But in agriculture going forward, I don't think there's anything to break this long-term relationship. I haven't found it in a 30-plus year career of studying it. And there are short-term anomalies and short-term violations. And if you were to plot CPI and 10-year rate, the only times they cross each other in an abnormal way are when there's massive fiscal intervention, generally at the end of great monetary expansion. So we have those moments in time. We had them in the 80s. We had them, for the last few years. But the long-term thesis is still unbroken.
So Bruce, the challenge that I'm facing in conversations right now with folks that are looking at farmland, if you're using leverage, you're paying, call it 8% for your capital right now, and using Iowa, Illinois cap rates, you're looking at 2.5 to 3% cash yields on your cap rate return, and you can go buy a T-bill and get 5.5. And so, we have a lot of folks that like farmland, they're saying, hey, I've never bought fixed income before, but I think I'm going to put my money into fixed income right now because, it's 200-300 basis points higher than the cash yield on farmland.
Yep.
And, what I'm hearing you say here is that if CPI is going to be running at 3 or 4, then your historical number would translate to 4 or 5% total return above what that CPI number is going to be at.
Yeah. And again, just to comment to the specific way you asked the question. Treasury, there's a very famous paper that points out that if you make a series of 1-year investments in treasuries, so right now you get a 4.5 or 5 or 4.75, depending on how far out on the yield curve or how short you are. And next year, if you repeat that investment, and the year after that, you repeat the investment, you make a series of 1-year treasury bill investments for 20 years. You're going to earn exactly the same return, minus a little bit of benefit for term premium, as if you had made a 20-year investment right now, or bought a 30-year bond and sold it after 20 years. And so this sort of seductive nature of current rates when they're short term, they have to eventually add back up to a normal yield curve. And so that can't last forever in the relative rollover advantage to the current cap rate. The other issue is that agriculture generates 2 kinds of return. There's a quote that I still haven't fully verified the original attribution to, but it's from the 1800s. That says there are 2 forms of return to farmland, one being the income from the production of the crops thereon, the second being from the gain in value of the underlying asset. The latter shall always be the greater. And the point is, appreciation should be expected. It's a non-depreciable asset. If we expect positive inflation, we expect that the nominal value of the thing that produces commodities will go up at least at the rate of the production of commodities, but we're increasing the productivity of land at the same time. And so, yeah, I think that the argument today is if you have exactly a 1-year holding period, don't buy farmland. One, it's hard to find, hard to buy, hard to sell. If your holding period is 20 years, don't buy T-bills. It's going to roll through that period of time and not generate the same, the transactional sum of those 2 sequences is different. The other attractive feature of farmland returns, I know we're getting a little more philosophical than talking about a region, but the other issue is if you want income, buy a high dividend stock. If you want appreciation and you don't need to consume the income every year from the investment, there may be other things to buy, but farmland has been this steady coupon. You can generate cash rent from it every single year, or if you're the operator and owner, you can generate an income that's a little more variable than cash rent, but still very stable compared to other investments, and long-term have the appreciation. So the tax advantage of being able to manage how much of the total return comes through your taxable portion is fairly unique to agriculture, and it's a fairly attractive feature.
Bruce, I want to encourage more of the philosophical, simply because I think we need to stand in the bully pulpit, and that's the purpose of the land report, is to convince more investors to look at land as an opportunity to really stake your claim, put multi-generational money aside in a way that offers great long-term returns, which you've just discussed, a lot of optionality, and as Steve has pointed out, all the different ways that you can take a piece of property and roll it through a 1031 into. Steve, go down your standard list of the different ways that you can 1031 a piece of property, please.
Yeah, I mean, you can 1031 exchange in and out of farmland from other asset classes, commercial real estate, trailer parks, industrial buildings, and so I think that's the benefit of farmland is you, as I've said, you can add leverage to it, and you can 1031 exchange in and out of it, and you've got all the optionality of unknown of what may hit, and we see it all the time. You thought you were buying a farm to grow corn and soybeans, and next thing you know, Amazon wants to build a distribution center in your area, or Microsoft wants to build a data center. And I just think the folks that are caught up in the short-term nature of the T-bill conversation, one of the challenges is just getting your brain around that lower return on farmland without understanding that optionality and that upside and how to utilize the asset class. And that's why I'm so bullish on farmland.
Dave, can I just ask you briefly to explain to those of our listeners who aren't familiar with a 1031 tax-free exchange what that mechanism is?
Yeah, you directed that towards me, Eric.
Yes, sir.
Yeah. So essentially, that's a section of the IRS code that will allow you to defer capital gains from the sale of a property with the purchase of a quote unquote like kind, which has the flexibility, as Steve mentioned, on moving across different asset classes. There's a number of regulations and specific rules, identification periods for finding the transaction, then ultimately executing the transaction. You have very specific windows, etc. And then there's particular rules around how to manage debt and how that has to be taken care of. And we certainly have plenty of resources that we can help folks with. But the key characteristic is that ability to defer capital gains. And
as Steve has pointed out, that's not available when you're selling an equity that you've seen a great return on, a lot of appreciation. You can't roll that gain into another equity or into a piece of property without paying taxes, correct?
Right.
Yep. Back to you, Bruce.
Well, just thought while Dave was going to transition to some things that he'll lead the conversation on. We want to turn a little bit, didn't want to put short attention on Corn Belt. There are other things that have really driven it. And I guess we should have mentioned just like the depth of the market. It's the gold standard of farmland investments. And there's been a lot of money that came to the States through COVID relief packages and other efforts, and market facilitation payments part of that. And the government support system for agriculture is focused there, but there's also a ton of generational money that wants to be in farmland in the Midwest. So that's also put a bit of a floor underneath prices. And what we've observed time and time again is that if you hand the data to an agnostic analyst on Wall Street, they go, gosh, prices of corn went down. This must mean that land values are going to decline. Like, well, no, corn prices go down when yields go up. So revenue wasn't off, or we had this flood, so land values are going down. No, there's crop insurance and so on. Well, and evaluating farmland, I think in the future is going to include this need that we kind of teed up last year and have put a little bit more detail in the report this year. And simply understanding how the conversation about greening of the energy complex is going to land over top of the areas where we produce things. When you put a wind tower on a farm, it doesn't take up much footprint for agriculture, but when you put solar over top of land, you lose that ability to produce. But the values are so dramatically different. And if we are moving in this direction, we're going to have some continued need for consolidation of the acres on which we produce things that we actually eat or use for energy generation. And Dave put together some nice materials on this. I'm going to kind of let you lead through this, but we'll try to chime in as well as you go through it about what we think the impacts are at the land level, focusing always as the thing that connects us is the land.
Yeah, thanks, Bruce. So, the signals have been clear, right? We've got the Paris Agreement, which, of course, politically in the U.S. has been an interesting dynamic. Under Trump, kind of pulled out, under Biden back in. The Inflation Reduction Act certainly committed a lot of resources. And this notion of net zero fits within kind of the broader conversation we've had here of land in general, farmland specifically. We see this pathway for expanding income sources. And the net zero piece is one that is starting to clarify a little bit, at least in the context of where policy goals are going. So just that really simple definition, right? It's that a net zero means that balance between the greenhouse gases that are produced and removed from the atmosphere. And generally speaking, the goal structures globally have oriented around net zero economies by 2050. And so this creates two really sort of clear avenues for farmland to play. First is that renewable energy generation piece, right? This is the greening of the energy complex that Bruce has referenced a few times. Another phraseology you'll hear a lot is the low carbon energy transition. And then the flip side of that is we are still going to have carbon storage, right? And the soil sequestration story is one that's real, and it's going to have to create value. So what we've done is worked on trying to gather some of the spatial data resources, some of the best estimates, and we've got documentation of which data resources we've kind of referenced and tried to pull this together. And what I would say is this is not a prediction or necessarily a forecast. This is more of an evaluation of opportunity, right? And so we need to look at what's come together here in that context. Obviously, there's a lot of things that are going to happen between now and if these goals are achieved in 2050 from a number of different perspectives, and then how it plays out is going to be an interesting dynamic also. So the renewable energy story is fairly straightforward. We can identify where wind and solar resources are. Okay, and it's a bit of an academic exercise from the Net Zero America project led by Princeton on now leveraging those resources into an economic equation where those resources are going to be deployed. And we broke it down by state here just a little bit. So the upper right map is the projection of wind generating capacity needed by state in 2050 in order to meet goals within some pretty defined scenarios. And the numbers get big. And the key thing that we'll point out here is just where this concentration is, right? So you're in the sort of eastern half of the country, primarily, certainly Texas, just from a land-based standpoint and topography standpoint, garners a lot of that wind energy. And Eric commented on what's deployed already. And then we see a lot that's going to hit farmland, right? When we're in Iowa and Illinois and even Missouri. And Bruce made the point that wind is a fairly low actual land use change kind of renewable energy source with solid income. So this is an interesting dynamic. Solar's different in the context of it is our land use change, right? So all of these characteristics driving farmland values and farmland income, that has a fundamental impact. We're talking about changing the land use. So solar's a little bit of a different dynamic in terms of how it integrates into the landscape. Now, it could fit really nicely. You know, we talked about water pressures and reducing acreage in California as an example, could create really interesting opportunity as a supplement where acres have to be retired in order to protect that water resource. Those kinds of dynamics across the country will sort themselves out. The biofuel story is incredibly interesting also. You definitely get a lot of conversation around the electric vehicle push, and in some cases, even regulatory regimes that are emerging, driving to electric vehicles, having downward pressure on ethanol. Context, you know, our ethanol production capacity is roughly 17.5 billion gallons a year. That's a little over 80% of the biofuels production capacity in the US. Now, when we look at net zero, there's a couple of liquid fuel uses that don't have a clear pathway to stepping off of liquid fuels. Aviation fuels one, diesel fuel for heavy machinery and heavy transport is another. And what we start to see is these really interesting dynamics where ethanol as a mixed alcohol molecule, potentially upgrading into sustainable aviation fuel. Bruce mentioned carbon pipelines earlier, which are really critical to lower the carbon intensity of existing ethanol so that it can meet the sustainable aviation fuel standard. That's another interesting land use component to it. Renewable diesel, right? Oil seed production and the pathways to getting to the roughly 45 billion gallons a year of diesel that needs to be replaced with a renewable source. The net biofuels impact looks highly positive. There's a lot of details to build out. And then the carbon soil sequestration of carbon is an incredible opportunity. Perhaps even the biggest one, depending on how values ultimately sort themselves out over time. The lower right map shows the carbon sequestration potential from no-till and cover crop adoption, two practices that are really common for storing carbon in the soil. And again, you can see that concentration within certain regions, Northern Plains, Corn Belt, Lake states, where that opportunity to store carbon and realize that value on the land is high. So Bruce, if you want to hop to the next slide. Did we lose you? There we go, Bruce. So what we've done, and again, this is not necessarily a specific forecast, it's more of an evaluation of an opportunity, is start to combine these sort of projected potential impacts and look at it at a state level. And then we've also aggregated this to a regional level. And, net potential impact, when we go to the bottom right of the table on the page here, is roughly 10%, a little under 10% of the total farmland value. And that value tends to concentrate in particular areas where the ability to take advantage of these income streams, these future income streams, is even stronger. And this is certainly a part of this broader story of expanding revenue within land and farmland. And we certainly want to make sure that this is fitting into the story on where we're going to go from a farmland value standpoint.
Amazing amount of concentration in the Corn Belt and Northern Plains. More than 50% of that combined total is just from those two regions.
Yeah, and you have to recognize the share of total land value, right? The farmland concentration, sheer acres, is very high in those regions. The Northern Plains, as a percentage, this value as a percentage of existing value jumps out again. And right, we've talked quite a bit about the Northern Plains being interesting from a return standpoint. And there's some real optimism when we start to look at this particular component of this notion of expanding income going forward.
Eric, Dave wrote a white paper that's on the People's Company website on the Inflation Reduction Act, as I call it, the Inflation Causation Act. But it's highlighting a lot of the capital investment that's going to go into these wind, carbon, solar projects, and a lot of it hit yet. There's millions and millions and millions of dollars that are going to be focused on this net zero future, and I don't think we've scratched the surface as to what the impact's going to be on agriculture and farmland. You simply have to have farmland as an equation to get to a net zero future. And so if you believe that this net zero future is on the roadmap, right, wrong, or indifferent, it is going to have an impact on farmland values. And so that's why we're making this such a big emphasis. I think it's something that you've got to pay attention to.
Yeah, Steve, to that point, looking at some Bloomberg data, the global investment into this low carbon energy transition is well over $1 trillion last year. And projecting forward, if we're going to meet the goals that are stated in all of these agreed upon policy documents, that has to average about 4.5 trillion globally through the rest of this decade. And so the alignment from a policy standpoint and what we're seeing both from a public and a private actual investment, those signals are very real right now.
I would add that not only they're real, but they're coming from all corners. 10 years ago, we had particular groups worried about ESG, and we had particular large moves toward requiring sustainability to be evaluated in investment programs. And then we moved to a little bit more attention on animal agriculture as a source of greenhouse gases. And then we have, that evolution has continued. But I think this converts in a very real way the finger from pointing at agriculture as a major problem to pointing at agriculture as a necessary part of the solution. And I kind of want to make that point in a couple of different ways. The ability to go without food is something we can't do. So the counterfactual, instead of saying, guys, don't produce any more food because agriculture, creates greenhouse gases. Well, we're kind of moved past that argument. And then we have kind of a political situation that says we're going to green the energy complex no matter what, at any cost. And then we have a societal view that says, well, of course, we want to be individually conscious of this, but we don't quite know how the mechanisms add up. And then we have what I think the greatest forces are, market forces, saying, well, if somebody's going to be able to pay for a reduction in the intensity by doing something, where would it land? And it lands in solar, it lands in wind, it lands into direct sequestration, and it lands in putting more organic matter back in the soil. Fossil fuels are just organic matter that's been stored for a really, really long time. And if you were to put more, photosynthetic caloric capture into places like land where you can then use it to grow more productive crops and put wind towers over land and so on. The important part of this study that Dave referenced as well is it takes into account return-seeking capital where this would actually happen, because the combination of acquisition and transmission is important. You can't just put solar out in the deserts, because transmission of the electricity from there to where people live is too expensive. And you can't put it directly over top of cities because the displacement of people is also too expensive. So where you end up putting it turns out to have a pretty good Venn diagram overlap with where we grow food anyhow. And that confluence of the conversational points and the reality of where there's value in doing it has, I think, completely turned the pointer, not quite 180 degrees, but toward agriculture as the solution, instead of protesting in the streets as the problem.
Yeah, Bruce, when we sell a farm now, I mean, it used to be what are the yields, and now where's the transmission capacity? How far are we from the substation? What are the KV lines? And it's changed the dynamic, and that goes back to why we started this energy management business up, because selling farmland and managing land is no longer only about what can I grow and what are the yields, and it's really about this whole energy dynamic. And what's exciting about like the carbon pipeline is that you're part of that net zero equation, but with the carbon pipeline, you're growing commodities that maybe will be turned into ethanol, and you're creating DDGs that are going to feed livestock, and you're doing that with a net zero impact. And so you're feeding people, you're powering vehicles, and you're doing it in a way that's a net positive for the environment. And that's what's exciting about this energy renaissance, if you will, that's coming out of all of these programs.
I think that's a great point. The base features that impact land through time have changed. And I feel like I'd be missing an opportunity to cite Leading Harvest as an example. And full disclosure, Steve was very important in forming that organization, and I'm currently on the board. But it's becoming kind of one of those ways of farmer-friendly, farmer-centric mechanism for simply recording what's going on. And I think moving towards sustainable outcomes starts with an inventory of what's going on. And it's becoming kind of a base feature, or table stakes, if you will, for farmland investments. And that wasn't the case 15 years ago. The NACREF members, we'll call them out totally positively, really led on the effort to perhaps avoid headline risk, but also to create a standard that everybody can agree on and say, what do we need to know about production? How can we manage our nutrient runoff? Nobody wants to lose nitrogen, but if you don't keep track of what the inputs and outputs were, it's hard to verify that you're moving toward better environmental outcomes. So I think energy management, environmental outcome recording, sustainable production features, this is a matured, completely different world than the one I grew up in on a small farm in Ohio. And knowing where things go, where they end up, being able to track what your fertility and your soil carbon would be, having an opportunity to capture wind on top of land that is still growing corn, having solar whose use is so valuable that you're willing to take 200 bushel an acre corn ground out of production. These are all part of the movement forward in the land markets that weren't there in our recent past. I'm going to move just to a summary slide just to manage our conversation a little bit. And we've talked throughout about the fact that income, interest rates, and inflation are still the major factors. And income comes from what you can grow, what the demands for it are, what the costs of growing are, so input costs, including water, fertility, transportation, and all of those move around through time. And interest rates, even though farmland has a very low leverage, 14% on average in the long-term side, it's still very important because it does influence the cost of control of that asset. And in the long run, as farms continue to get larger and commercially managed farms are larger than perhaps one individual could or should own, that will become an important feature as well. And then likewise, inflation as from my perspective, still one of the very best inflation hedging assets possible. This recent period we've had is going to normalize, whether we're talking about the appreciation or inflation or interest rates. We're not going to have the same degree of sort of hyper chaotic movement in local markets that we've had over the last 3 years. Hopefully, we won't have major world disruptions again, like pandemics and wars and trade spats that lead to the need for as much government money transference. And the fourth bullet point there, in the long run, I believe there's going to be more people in the world, and I fully believe they're going to eat. And so if you look for the long-term demand for calories, it turns out we're going to multiply the demand for calories just by the amount of protein that people want to eat as disposable incomes go up. That's a very, very long-term, very, very positive, absolutely supportive part of the thesis for farmland investments. The item we just talked about, the greening of the energy complex, we're definitely headed there. We don't know where it's going to end up. I don't make many predictions about it, except to say that it's not a conversation that's going away. And again, sorry that I'm speeding through these a bit, but the farm bill debate, we've completely, we haven't had that conversation yet. And if you were to read the, ag press right now, you would have thought that was probably the thing we should have focused on. Well, I'll tell you this, eventually we'll have one. Eventually it'll pass. And generally they grow in scale. And so we're going to probably have more support for conservation activities, probably going to have more support for crop insurance, probably going to have more support for things that are related to smart climate related agricultural activities. I didn't use climate smart on purpose there, but things that we will figure out ways to look at the impact in the environment. And then in the end, the long-term positive correlation with inflation, short-term negative correlation with equities, long-term behavior, as I love Steve's description of it, as it's like a gold with a coupon kind of thing, or a T-bill that has appreciation on top of the annual clip. This fact that there's a constant current income and long-term appreciation, those will really, really continue. And the farmer backing on this, it's a very thin market. And when land sells, it's probably been held for 50 to 100 years in that location. And so the neighbors have a really strong reason to worry about, will they ever get another chance? And so this underlying support for thin market, long duration assets leads to the thing that in a room of farmers, I always ask, you think farmland values are too high? Who wants to sell me their farm? And nobody will put up their hand, because it's for both the farmer, for the investor, and for society, kind of the answer to the question, what asset would you rather own?
Okay, based on that, Bruce, let me just ask you to gaze into your crystal ball and just generally prognosticate about land values in 2024. In fact, I'd like to go around the table with you and with Dave and Steve as far as what do we see in next year besides another fabulous land investment expo?
So, I'll lead on that a little bit and just say that this is one of the cases where long-term forecasts may actually be easier than short-term forecasts. Next year, I'm not as sure about the directional impact as I would be for long-term. In the short term, I think we'll have a reasonably positive period of time. But in the long term, I think we're going to be very, very positive. So next year, I think it will be driven by short-term effects. The long term, though, I'm not quite sure how to say more than I expect the characteristics of the asset class to continue.
Dave, do you want to hop in with your thoughts?
Yeah, I mean, it's a super question, Eric, obviously. And the dynamics, we've gone through all of the regions, and I think about these things down at the asset level and how it plugs back in to each particular region's characteristics. And so, there's a handful of very specific theses that we're pretty excited about, and we're working with investment partners, looking more broadly and kind of generalizing. The reality is that this run in prices and really, really strong prices brought a heck of a lot of land to market here over the last 2 to 3 years that maybe wouldn't have come to market previously. And we definitely have seen some settling. I think Bruce used the phrase a bit of a plateau. That seems to be the right answer carrying forward. And so largely you probably are going to see less hitting the market. And I think all of the transactional platforms are sort of noticing that in a pretty clear way. And so that puts us in this dynamic where there's still a heck of a lot of demand. Supply will be down. And so it's hard to see significant corrections in that kind of environment. And then there's going to be particular cases, particular regions and production theses that are going to continue to draw interest and have quite a bit of competition coming in as well. So generally speaking, not as hot, lower supply broadly, and probably kind of settled in here, as Bruce mentioned, from a short-term standpoint.
Steve, how about you?
Yeah, they've hit on all the main points. You know, a couple of the drivers where 1% of the land hits the open market on an annual basis. There's just very limited inventory. There's more money that wants to own farmland than there is farmland for sale. That dynamic's not going to change in 2024. Bruce hit on the leverage. You've got less than 14% leverage on farmland nationwide, $4 trillion asset class with that limited amount of leverage. And so while the interest rate impacts will impact some buyers, I don't see the interest rate impact impacting the overall farmland market. So thinly traded asset, limited amounts of leverage, and Dave touched on it. Expensive high land markets bring land to the market that otherwise wouldn't be for sale. And there just isn't going to be forced sale. There's not enough pressure out there. Farmers have been making good money for the last 2 or 3 years. Balance sheets are strong. Crop insurance buffers any losses that are out there. And so you're not going to have land come to the market if people don't like the price. And so I think if you were looking at commodity prices only and interest rates only, you could talk yourself into the land market's going to soften in 2024. But as we talk through all these factors today, limited supply, lack of leverage, generational wealth, and the optionality of farmland for the long haul, I think the land market stays flat. And even the last 2 or 3 weeks, we've seen the land market spike in the Midwest. Just in Iowa, Illinois, Minnesota, the last 2 weeks, there's been over 1,100 acres that have brought 20,000 an acre or more. And so we're seeing a lot of strength in the market. And if you would ask me in the summer, I would have been more in the camp that it might soften. But right now it feels like interest rates are pulling back a little bit. And I think the land market's going to remain pretty stable in 2024.
You and I yesterday were talking with Esther George and Tom Honig from the Kansas City Federal Reserve Bank. Both have served as presidents there. And one of the things that they hit upon, they're obviously going to be speaking at the 2024 Land Investment Expo, is the amount of flux in the system as far as an election year goes and how that's going to play into what happens throughout 2024. I think that's going to be one of the reasons why people are going to be attending and tuning in, whether they show up in Des Moines or actually tune in online for the expo, is to try and get some better insight onto what are some of the short-term variables that are going to be affecting investments and land prices.
Yeah, we had a great conversation, and I think folks are going to really enjoy hearing the panel discussion with you and Esther and Tom. And Tom was the Kansas City Fed president back when Paul Volcker was Federal Reserve chairman, and obviously took interest rates into the high teens. And he also served under Alan Greenspan and then Ben Bernanke, and had the most dissenting votes in Fed history. And so the insight that they're going to provide around inflation and interest rates, I think is going to be fascinating to hear, and excited to have them on the program.
I think it's going to be our best expo to date. When I look at some of the insights we're going to be getting from speakers like Tom and Esther, obviously a neat preview with Drew, and to see Drew Bledsoe and to see, and then he's really picked up some great tracks in and around Washington and in Oregon. And Representative Gallagher, I mean, we have a really great, we have a great lineup shaping up. Dave, you and Bruce will also be participating at the expo, will you not?
Yes. Yeah.
Great. Great. Looking forward to it. I'm just going to say that I think, I'd like to close by thanking Steve and of the People's Company, Steve Brewer, Dr. Bruce Sherrick, the director of the TIA Center for Farmland Research at the University of Illinois, and Dr. Dave Muth, director of People's Company Capital Markets. As Bruce mentioned, the full-length 44-page National Land Values report, you can download that. It'll be available to download later today at the People's Company website. I encourage you to do that and to really get the skinny on all of these key areas, these key metrics, and these data-driven inferences that are available to really help you understand and better look at your investments and investment opportunities going forward into the new year. For Steve Brewer, Bruce Sherrick, and Dave Muth, I'm Eric O'Keefe at the Land Report. Thanks for joining us today for the National Land Values webinar.